All right. Good afternoon, everyone, and welcome to our webinar. I am Kristy Alballero. I am COO and co-founder of iUgo. iUgo is a tech-enabled tax and accounting software and services company. We work with hundreds of startups and small to medium-sized businesses with all of their tax and accounting needs. And today I'm here to talk to you about business taxes, but I can't escape talking a little bit about accounting because everything builds off of accounting. So I just have to talk about it. But primarily, given the time of year, I will be speaking mostly to about taxes and how it relates to your business. So today specifically, we'll talk about the financial responsibilities for you as a business owner and CEO. Also, what you need to know about business taxes, high level, and then we'll get into more details like how to lower your tax bill with deductions and credits. Also, what are the latest tax updates and changes that apply to your 2021 tax year, but also what to look for in 2022. And then finally, I will wrap it up with talking about tax planning because now is the perfect time to be thinking about that. Even though most business owners don't think about it till the end of the year, which is also the time they tend to think about taxes, sometimes that's too late. So now is the perfect time to start thinking about it. And I will talk about some of the strategies that you can think about for your business. All right, so let's get right into it with the financial responsibilities for your business. And like I said at the beginning, everything builds off of your accounting, specifically your books. And your books is you can relate that to a pile of dirty laundry. That's why you see that there because the longer you let it sit there, the taller that pile gets and the stinkier it gets. And so with bookkeeping, it's really important that that's something that you're thinking about not just every month. I mean, depending on the volume of transactions that you're working with every month, but sometimes it's even something that you need to be thinking about weekly. And then if it is that frequent, maybe that's someone you have to hire to help you, but it's still something you have to address. Where you're taking anywhere from 30 minutes to an hour every week, um, classifying your transactions. So you're looking at how many came in and how many came out, and you're making sure that you're categorizing that appropriately. And it's really important to do that monthly because what happens is if you put it off to the end of the year, you're going to forget a lot of why you spent money on certain things, and you end up spending more time trying to figure out and think about like what was it that I spent that on, why did I spend it on that. And so not only you taking longer because you're having to remember something from 12 months ago, uh, but also the fact that you're doing a year's worth of bookkeeping all at once makes it such a daunting task. And that's when a lot of people associate the time factor when it comes to taxes because you're trying to organize all of your books for the year at one time. When in reality, if you're keeping up with it every month, you can take your books and hand it to your tax professional or email them or whatever way that you communicate with them. And they should be able to take your books and create that tax return from there. So, again, keep up with it month after month. And part of that's also reconciling your accounts. And so, what reconciliation is it's looking at what's in your bank account or your credit card statement, and it's comparing that to what you put in your books and making sure that those balances match. Because if they don't match, that means you did something wrong. And you have to go and kind of dig in and figure out where did it get entered incorrectly. And the challenge comes in if you're not doing that till the end of the year and there's a mistake in January or February and you're having to go all the way back, it has a domino effect on everything. And so it can make it a much more tedious process, to clean those up later on. So keeping up with that monthly is important. And all of that leads to being able to create basic reports. And basic reports are important when you are trying to raise capital for your business, or even if you're trying to get debt financing. A lot of times, banks are going to want to see what your books looks like. Not, they'll also want to see what your bank account looks like, but also, how's your business doing? Or also helps you make decisions. Are you burning through cash more faster than what you're taking in? So do you have to budget appropriately? Or do you have an influx of cash where you can think about how you take that influx and grow your business even more? A common example I like to use on why the reports are important is over the last couple of years we've all been dealing with the COVID pandemic, and where a lot of businesses couldn't operate because nobody was spending money or going out. So the government came in and said, all right, businesses, will help you out with a PPP loan or economic injury disaster loan. And that was all done through the SBA. And there was a couple rounds of each that were given out. And in the second round for both of them, the SBA said, yeah, we recognize that you need help, but we want to see your financial reports. So then those businesses that really needed that money, that weren't keeping up with their books, were left scrambling to try to clean them up real quick so that they could create that report so they could get that money. So another reason why it's important to keep that up to date, because you never want to be stalled when all of a sudden you do need it. You never think that's going to happen, but if 2020 has taught us anything, is to expect the unexpected. So always be prepared. Eventually, you're going to have payroll, if you don't already, where you pay yourselves or you hire employees or even contractors. And with all of that, you're going to have certain filings that you're going to have to do, and I'll get into a little bit more about those filings later in this webinar. But it is important to know what those requirements are for you as an employer when you have payroll. And then if you have a physical product that you have inventory, you're also going to have to reconcile that monthly, making sure you're not losing out any inventory there. All right, so I told you I was just going to talk about the basics of accounting, but now we're going to get into the taxes and what you need to know, especially right now that we are in the prime time of tax season. So the first thing is knowing what your requirements are for tax filing, and that's going to start with, what are your deadlines? And the deadlines are going to be dependent on your business structure. For most business structures, the deadline is the same as it is for individuals, which is April 15th, except for this year, which is April 18th. For S corps and partnerships, the federal tax filing deadline is actually March 15th. So super important that if you are an S corp or partnership, that you're getting ahead of that, working with your tax professional so that you can meet that deadline, because it's about 5 weeks away. And then the tax credits is what credits apply to you in your industry. Most credits are very specialized, so it's important to work with a tax professional that is familiar with other businesses like yours that can talk you through some of those credits. One that I'm going to talk about later is the R&D tax credit, which is a really popular credit that startups are taking advantage of right now. And I'll get into the details later in the program. Then there's IRS communications. When you get those letters in the mail, sometimes it's just informational, and sometimes maybe you did something wrong. You might owe some money, and this can be business or personal. And the worst thing that you can do is to ignore it. Even if they're asking for money and you don't have the money, what they want is at least an acknowledgement. So pick up the phone, write them a letter. They'll work with you. Chances are when they're asking for money, they understand that most people can't pay it all at once. But they just want to work with you, because if you don't respond to them, the letters get scarier and scarier, and those penalties keep accruing and accruing and accruing, and interest as well. So it's a kind of a double whammy there. So don't ignore those letters. And then there's tax planning, and that's where I'm going to wrap up the webinar, getting into the details of planning for taxes, whether that's paying for it or implementing strategies to help reduce that tax bill. There are things that you can do for that, but it's better to start those things now than try to do it all at the end of the year. All right, now for the super fun stuff is, what are the types of taxes? There's the income tax that everyone faces, which is the tax that is assessed on any profit that your business incurs. If you are an S corp or a partnership, that tends to get passed through your business tax return to your personal tax return and is taxed at the rate of whatever tax bracket you fall into. I'm going to get into the sole prop here in a second. And then there's the C corp that is taxed at a flat rate of 21%. If you are a sole proprietor, which means that you're reporting all of your business income and expenses directly on your personal tax return, you're going to see a bit more taxes. So when you work for an employer and you are receiving a salary, that employer is holding back some taxes. That there's the federal taxes that you agree to pay, and then there's also the Social Security and Medicare taxes. And as an employee, you are paying actually 6.2% of your salary towards Social Security, and you're paying 1.45 of your salary as part of your Medicare taxes. But what's also happening is your employer is also paying 6.2% of your salary towards Social Security, and they're also paying 1.45% towards your Medicare. So when you don't have that employer side of it, you as a solo entrepreneur are responsible for both sides of it. And that's why the sole proprietors tend to see higher taxes because they are paying both sides of the equation when it comes to Social Security and Medicare. But on the flip side, it's important to know that if you have employees that are on payroll, that you are withholding that federal income tax and that you're paying on their behalf that federal income tax as well as their portion and your portion of the Social Security and Medicare. And then there's also FUTA taxes that get paid annually, usually at the end of the year for smaller, medium-sized businesses. Employment taxes are filed and paid quarterly. So you can pay into it monthly or even after every pay cycle, but that form that you file is paid quarterly after the end of each quarter, usually by the 15th. And then it's really important that you distinguish who is an employee versus who is a contractor. Because, like I mentioned earlier, the contractor is responsible for their own Social Security and Medicare taxes. This is where you, as a business owner, save money when you hire a contractor instead of an employee because you're not paying those extra taxes. But if you're treating that contractor like an employee, that contractor can go tell the IRS, "Hey, I was an employee there, not a contractor." And if there's proof that says that was the case, then the IRS can come to you and say they're right. You need to pay that 6.2% for them and 1.45% for them for the Social Security and Medicare taxes. Plus, they'll assess some penalties on that. So make sure that you are correctly distinguishing between the two when you're hiring. And then there's estimated taxes. So the way the US tax system works is that the expectation is that you're paying taxes throughout the year. So when you're a salaried employee, those taxes are being withheld. If you end up overpaying, that's where you see a refund when you file your taxes. But if you're underpaying, you end up having to owe taxes. So if you're not paying as you go or you're not paying enough as you go, the IRS actually, will assess a penalty, an underpayment penalty for not paying enough into it. And so that's us as an individual or a sole prop, but also applies to corporations. So if you think that you're going to have profits of at least $400 or more throughout the year, then it's important to get on that payment structure where you're paying into it once a quarter. And just like the payroll taxes, they're due by the 15th after every quarter. Actually, payroll taxes is due by the end of the next month, but with your estimated taxes are due by the 15th of the following quarter, each quarter. And so, like I said, if you don't pay, they're going to assess a penalty. And if you got a refund one year and then you owed the next year, they're not going to assess the penalty because that never happened before. But if you're doing it year after year where you're underpaying, they're going to say, okay, look, you should have learned last year, but you didn't. So now they're going to hit you with a penalty there. And when it is time to pay, whether it's quarterly or after the fact, you learn that you owe taxes, you can go online. They have a EFTPS system where you can connect it to your bank account, make a payment. There's also some other options outside of the IRS connection where you can make payments through credit cards, or you can mail in a check as well, as long as you have Form 1040 ES with it. And when you're figuring out how much you have to pay each quarter, it's part of it's as simple as determining how much do I think I'm gonna have to pay in taxes for the whole year and dividing it by 4. So if you think you're gonna owe $2,400 in taxes, then every quarter you should be paying $600. But if you're not sure, that's a great time to reach out to a tax professional to help determine that. Or you can also look at what did you have to pay last year, and if you are expecting to have to make even more this year than you did last year, then you can always take that, multiply that by 110%, and then pay accordingly every quarter based on that number. So we've talked about paying into taxes. Now let's talk about how we can reduce the amount of taxes you have to pay. And it starts with deductions. Deductions are going to lower your taxable income. So there's a ton of different types of deductions, and some of them I'm going to talk about them high level at first, and then I'll get down into the nitty gritty of some of them later. This is important because this is the part where it really helps to save on taxes, because the more business related expenses that you can claim, the less taxes you're going to have to pay, if any. So in your income statement, you always look at how much you brought in and then what was the cost of what you brought in. And so that's the first one to talk about, is your cost of goods sold. Your cost of goods sold is anything that goes into producing that product or service. So if you are making scarves and selling scarves on the internet, then the yarn that you purchased and the scissors that you used to cut the yarn are all going to go into your cost of goods sold. You couldn't have made that scarf without that yarn. And if you have someone that you pay to knit the scarves for you because you can't do it all yourself, or you pay yourself even a salary, then to knitting the scar and to knit the scarves, then that's going to go into your cost of goods sold. So it's your materials, your labor. If you have a storage unit because you've got thousands of scarves, then that storage unit is also part of that cost of goods sold. Of course, any other employees or contractors that you've hired to help in the business operations, all of that is 100% deductible. It is important to note that at the end of the year for your employees, or actually in January, you have to file a W-2 for them so that they can go file their personal tax return. And if you've got any contractors that you paid more than $600 last year, then you have to issue them the 1099 NEC, which stands for non-employee compensation. And if you haven't done that yet, you better go do it like right after this webinar, because that deadline already passed back on January 30th. All right. And then there is where you work. So if you're renting an office space, then that rent for the office space is deductible at 100%. If you are paying for internet, electricity, water, anything for the office space, all of that becomes deductible. Now, I know that since COVID hit, most people are working at home now. I'll get into those deductions that you can claim for your home office space a little bit later. Bank and accounting fees. So you may not think that whatever your bank charges to maintain your account on a monthly basis is deductible, but it is. Or you might have a credit card that comes with an annual fee that you use for your business. That's deductible. If you were a little bit irresponsible and got hit with an overdraft fee, it's still deductible. Wire fees, all of that's deductible. If you're using an accounting software like QuickBooks or Xero, the cost of that software is deductible. Or if you're paying an accountant or paying for a service like iUgo, all of that is 100% deductible. Insurance, whether it is health insurance, business insurance, accident insurance, all of that is deductible because it's for your business. Auto insurance for a car that is used for the business, it can also be deducted as well. And I'm going to get into more details about car related deductions also here in a bit. You have to promote your business. So any advertising fees. So you're paying to promote your business on Facebook or Twitter, Instagram, or you put it in the church bulletin or in the local paper. All of those are obviously deductible. In any designs that you created for that promotion, you paid someone to design something, you created flyers to promote it, all of that can be deducted for the business. You're traveling for a business. So, and I'll get into car mileage, but your trip to the airport can be deducted. Your airfare is deducted. Your meals to a certain extent, and I'll also get to that in a minute, can be deducted. You tipped the valet guy, all of that's deducted. You parked at the airport, you stayed at a hotel, you rented a car, all deductible expenses. We've talked about the taxes that you have to pay, your payroll taxes, there's unemployment taxes, all of that is deductible. Your business licenses, there's going to be some state and local taxes that you have to pay that are also going to be deductible. If you have any property taxes, that's also deductible. So when you're first launching your business, you're going to incur a lot of startup costs and organizational costs. So there's going to be some legal expenditures that you probably end up paying to kind of organize the business itself legally. There's going to be some state fees that you're going to incur as you're establishing your business with the state. There might be some training, some travel expenses. And for those expenses, you can stretch them out over 15 years, or you can claim up to 5,000 of them in 1 year and then stretch out the rest of them. But those are called startup costs. And so those are costs you're incurring before you're ever even generating any revenue, which is why there's kind of a limit on how much you can claim up front. All right, so now let's get into assets, which is going to kind of lead into the cars and stuff. So, if you're buying a big purchase like a car or real estate or equipment, then that can be depreciated. Then it's a capitalized deduction. Now, there are some exceptions, like there is to everything when it comes to the car. And I'll get into that in a minute. Before I do, actually, let's jump to that right now, and then I'll go back. So, if you use your vehicle for business, but use it for both personal and business, there is a cap there. There are things that you can deduct. So, let's say that about 25% of your time is used for business. Then your best option that you're going to look at is taking the standard mileage. And what that means is that you're tracking your trips, whether it's to the airport to visit a client, things like, maybe it's to the post office because you had to ship something for a client. All of that travel can be deducted simply by taking the number of miles that you drove there and back and multiplying that by 56 cents per mile. And so that 56 cents per mile is covering what you would incur in gas and overall wear and tear on your vehicle. With this option, this one is the easiest one to use. It still requires you should keep a log of those trips where it says where you went and what was the business purpose of that trip. The other option, this is better if you're using it more frequently, more than 50% of the time for business travel, is when you're taking the actual expenses. So let's say you drive a lot between Houston and Dallas, back and forth. You could track your actual gas bills. You could claim your car insurance, which I talked about earlier. You could depreciate the car. You could, any maintenance that goes in the car, you can take all those actual expenses and deduct that. But you can only deduct it up to so much. So usually you can only capitalize it over the course of 5 years, or depreciate over the course of 5 years. But there, like I said, there's exceptions to everything. So you can, if the vehicle qualifies, you can deduct most of that vehicle, if not all of it, in 1 year through what's called a Section 179 deduction. This is going to be important for anyone who's seeing a lot of profit in their business and they really need to drastically reduce their tax bill. The 179 depreciation or deduction can be a big saver there, but you have to have used your vehicle more than 50% of the time for business purpose, and it had to have go into operation the year that you bought it. So just a couple of caveats there, but there are options there to dramatically lower your taxable income. All right, so then talking about meals, typically, so before 2021, all meals that, whether you went and took your employees out for lunch or you met with a client for lunch, those were only deductible at 50%. Again, it goes back to the COVID pandemic, because a lot of restaurants were suffering as a result of people not wanting to go out as much. The government came in and said, all right, let's incentivize people to go out to eat at the restaurants. And so one of the ways they did that was to make those meals for businesses 100% deductible. So this was the case not only for 2021, but actually this year all the way until December 31st. You can take advantage of this and not feel bad about spending company money on, as long as you're reasonable, company money on eating out, because you get to expense it at 100%. Now, if you're traveling, those meals are still only 50% deductible. So it's a little bit different for traveling meals, but otherwise it's 100% deductible. Now, meals kind of used to be grouped in with entertainment, where entertainment was expensed at 50%, but now entertainment can't be expensed at all. So that means, not to say that you can't reimburse it as a business, but you can't deduct it on your tax return. So if you are eating out and there's going to be alcohol, or there is a show of some sort, you're in Vegas, maybe, you kind of have to split out the entertainment part, which includes the alcohol, from the meals part, so that you can claim the meals for 100% deduction, but you can't claim the rest of it. But always an exception. So if it is an employee event, like a Christmas party, maybe you're having a 4th of July party or something, that is 100% deductible. So treat your employees and feel good about being able to deduct that at 100%. Also, if you purchase anything for a demonstration of your product or service, as long as you're using that something, maybe it's a table, maybe it's a iPad, but it's used for business use only, then that's also deductible. All right. Now let's talk about the home office, because I think this is probably the most common one we get asked about at tax time. So if you are a sole proprietor, so you're paying them big taxes that we talked about earlier, it's easy. You get to deduct whatever percentage of your home is used just for your business. So let's say your home is 2,000 square feet. Your office space is 200 square feet. You can deduct 10% of your rent and utilities and everything like that on your tax return. But if you are not a sole proprietor and you are an S Corp, C Corp, or a partnership, then there are still ways where you can do the same thing, but it's not as straightforward. So in that situation, you would have to set up basically an accountable plan where the company reimburses you for that percentage. So still very similar, just different on how it's recorded in the books, and then it can be deducted. Okay, excuse me. And then there's work clothes. A lot of times people think I've got this fancy event I have to go to. I have to buy a dress or a suit just for this event. I should be able to deduct it because I wouldn't have bought it otherwise if it wasn't for this work event. Unfortunately, it doesn't always work that way. And in most cases, you can't deduct clothes like that. But if there is a required uniform for the business, or maybe you're buying logoed shirts for your employees to wear to an event, those type of things, then you can deduct those. Okay. We went through vehicle expenses already, and now let's get to credit. So deductions help lower your taxable income, and credits help just lower the amount of taxes that you have to pay. So there's a few I want to cover. One being the foreign tax credit. So if you are doing business outside of the United States and you are required to pay foreign taxes, then you can actually claim those foreign taxes as a credit on your US tax return. So pretty cool. Also, if you set up a pension plan for your employees, then you may be eligible for a credit up to $5,000 to kind of help recoup those costs. R&D tax credit, my favorite. So the R&D tax credit, if you qualify, so that means that you are designing, developing some kind of product, software, technology, whether it's a process, techniques, or formulas. You're creating something brand new. You're improving on something that already exists. You may qualify for this. And the way it works is all of those costs that are going into the research and development, which is primarily going to be what you pay the employees doing research and development, or even to a certain extent, contractors as well, which can add up quickly. Payroll is your biggest cost, usually followed by marketing. So when you add up all those costs, it goes into a credit calculation. And then that credit can be applied dollar for dollar in one of two ways. One, you can apply it to any income tax you owe. So you're profitable, you owe income taxes. Most startups aren't profitable the first couple years, and because they're spending a lot of money on employees to build whatever product or service, and they haven't built up enough sales yet. So this is where it's a great incentive for startups, because if you're not yet profitable, but you are paying employees, you can take that credit and apply it to those payroll taxes we were talking about earlier. So the Social Security taxes that you have to pay on behalf of your employees, you can take that credit and use that to pay it, basically, and you get to keep that money in your pocket, put in more research development, put in more marketing. So it's a really great way to save money as a startup when you're really trying to conserve money as much as possible. So that's something we help a lot of startups with, and it's a credit that can be carried over year. You can actually claim it for multiple years. Usually, in order to claim it, the biggest piece of it is putting documentation together that proves you qualify for the credit. So it's usually through a case study. And that's something we help a lot of businesses with as well. So I had mentioned earlier, with the mileage that you need to keep a log of that. But with anything, it's super important to have documentation that backs up anything you're claiming. So that's going to be receipts. Mileage are basically your two biggest things. A lot of softwares out there will allow you to download an app, take a picture of your receipt, and it's automatically in your books already. So if you were to get audited, you already have your proof right there versus going through a shoebox full of receipts. If you're not sure about any credits or deductions that you might qualify for, this is where a tax pro is super helpful. They can talk, first, learn about your business, then walk you through what your options are. And they must be normal expenses, if ordinary. They can't be extravagant. So if you thought that 90-inch 3D curved TV was necessary to show your presentations on, maybe in your home office, might be a little bit extravagant, but it's a gray area. All right, so let's talk about, what were the things that have been happening, not just for 2021, but also looking for 2022. I mentioned earlier about the PPP program and the EIDL program. That was the loans that were given to businesses to help them basically get through that pandemic when nobody was spending money. So, good news is if you got one, it's very easy to get forgiven as long as you prove that you spent that money on qualified business expenses, which was usually payroll. So, if you spent that money for the PPP correctly, then and you proved it, then the SBA said, "All right, you don't have to pay it back." Typically, for a loan that gets forgiven like that, the IRS says you got to pay income taxes on it. But given the circumstances, they said you don't have to pay income taxes, which is a huge win for businesses. And on top of it, the how you spent that loan money is also deductible because it was a business expense and there's no limitation that says, well, you can't deduct it though. They're saying you can deduct it. So free money and you get to deduct those expenses. So super cool incentive that businesses got to see over the last couple of years. A little bit of icing on when things were really tough. I mentioned a few times business meals, 100% tax deductible only through the end of this year. So go enjoy some nice meals out with clients and feel comfortable expensing 100% of it. Charity, if you are a C Corp, you can deduct any cash contributions or even food donations, but only up to 25% of your taxable income. So if your taxable income was $20,000 and you donate to charity $20,000, no one's stopping you from donating $20,000, but you can't deduct $20,000. You can only deduct $5,000. Also, more COVID related items. So 2020 and even up until Q1 of 2021, if you had an employee that was unable to work because either they had COVID or they had to take care of a family member that had COVID, there was a credit that the business could claim because they lost that productivity from the employee not being there. So that expired April 1st. But if you didn't claim it for Q1 of last year, you can still claim it. But anything that happened after that, you can't. If you were self-employed, you can't claim it at all anymore, unfortunately. Another incentive for businesses to help navigate through COVID and help companies save money was through the employer retention credit, where they could save on the Social Security taxes that that the employer had to pay on behalf of the employee. There were some limitations on it, but that was something that was allowed up until June 30th of last year. Again, if you haven't you filed your 941 for last year, hopefully you have by now. That's something that you can still take advantage of. Okay, so tax planning is super important if you want to try to implement any strategies to save on taxes. A lot of people, like I said at the beginning, a lot of people don't think about it until the end of the year when really you should be thinking about it now. Because the last thing you want is a surprise tax bill at the end. All right. So, one of the big ways that you can save on taxes is through a 401k program. So, a 401k program, the employee can contribute to their 401k, and you as a business can match that however much you want to match it. And whatever you match is deductible. So, this is a popular program for S corps that they're a company of one employee themselves as a business owner, because it allows them to really build up their retirement plan and have half of it deductible for their business. So let's say that you as an employee of your own S corp paid yourself $100,000 and then contributed $15,000 towards your 401k. The business can also contribute another $15,000 to match what you put into it. So now your retirement plan just grew by $30,000 in 1 year, and 15 of that is a deduction for the business. So things like that are really cool strategies that you can put into place, because that not only are you lowering your business profit, but then you personally, even though your gross income was 100K, your taxable income is actually 85K because of that 401k contribution. Um, and also any assets. We talked about if certain vehicles qualify, you could get that big depreciation or that all at once depreciation through the Section 179 deduction. Also, any big equipment, you can always just buy outright and have that as a deduction that drastically can lower your uh, tax liability. And this business staffing also kind of ties back to your accounting, looking at, what is your available cash? What does your cash flow look like? And are there ways that you can incentivize your staff? Especially right now, it's really hard to hire and then retain good employees, because it's at the employees market right now. It's really hard to hire people. So looking at ways that you can incentivize employees to stay with you, through benefits, a 401k plan, other deductions. Um, and then, looking out for new credits that help you retain employees. Um, and then it's super important that you're reviewing your expenses monthly, because a lot of times we've seen with businesses when they first started out, signed up for a subscription plan, forgot about that subscription plan, haven't even been using it, but also haven't been reviewing their books, and they've been just throwing money out the window every month. So it's important to review your expenses every month. If you have anything that you're paying through a personal bank account or a personal credit card, now is the time to move that into everything to a business bank account and a business credit card. And the reason for that is, if you're not doing it now, at the end of the year, you're going to have to split out what was personal and what was business. And again, this makes it even harder, aside from if you had a business credit card or business bank account, having to remember, what things are for. Now, if you have it commingled with personal, you have to remember what's personal, what's business, and then what that business was for, what that business expense was for. So if you are commingling the personal and business, split it out. Um, get a separate business bank account, get a separate business credit card, and you'll thank yourself later. Also look at what your business structure is. So a lot of times when you are first starting out, you're probably spending more, you're not making a whole lot. Maybe it's like 10K for the year. There was no reason to go look at incorporating yourself as an S corp or C corp. But as time went by, business got better and better and better. And maybe you just got used to filing a certain way and then not realizing what the tax benefits are of a different business structure. So maybe you've outgrown your proprietorship, or you have some assets that you need to protect, or you're looking for investment. Most investors want to invest in a C Corp. And although I've seen some do investments S corps, most invest in C corps. But if you're a sole prop, you're definitely going to have a hard time getting investment. Or maybe you're an S corp and you need to think about becoming a C corp. So those are things you need to look at. And if you're not sure, definitely talk to a tax professional that can help talk you through what the implications are tax wise of the different business structures. Also, understanding that, maybe you just got done paying a taxable from 2020 and you have to prepare what that looks, or I'm sorry, for 2021. Now you have to look at what it looks like for 2022. Again, a tax pro can help you understand how to plan for that and start paying those estimated quarterly taxes. So, in general, like I said, now is the time to think about tax planning. but it doesn't mean that if you do it now that you don't think about it again until next year. In fact, it's something that you should be doing throughout the year. About once a quarter is what I would recommend because things change. The plan you put into place was based on one projection, and let's say business really boomed. Now you have to make some adjustments because that tax bill could be bigger than you thought. Or the opposite. Maybe you're not doing as well as you thought you're going to do, and you might be overspending. So, again, making those adjustments so you don't overspend your money. So, quarterly, you should be reviewing your reports and what your tax strategy looks like for that year. And again, that's going to be based off of your books. Do that monthly. If you don't have time to do it, find a service like iUgo where they are categorizing your transactions weekly, reconciling your accounts monthly, and they're telling you how your business is doing every month after they close out your books. But let's not stop the conversation here. Definitely follow me on social media. I'm always putting tips out there, not just for tax and accounting, but for businesses in general. So definitely follow me or iUgo. They are putting tips out there for tax and accounting, which is important, especially right now. We're letting you know of all those deadlines so that you don't miss those deadlines. So while you're out there promoting your own business, let iUgo remind you got W-2s that were owed last month, or you have your tax return that's due in about 5 weeks. We're good at letting our followers know that. And if you want a free consultation, I'm happy to talk to you about your tax situation or even your accounting situation. You can use that same link. You can talk to one of our experts for free. Just talk about your situation, see if there's a fit there. There's a no pressure conversation where we just like to help other startup founders. This is new territory. Taxes are scary. I covered a lot, and maybe not all of it applied to you. Maybe there's something you want to hone in on. We're more than happy to talk about that with you face to face. All right. So thank you so much for joining this webinar today. I hope you got out of it everything that you needed to, or at least a way to start that conversation. But I wish you all the best of luck in your journey as an entrepreneur, and I hope to talk to y'all soon. Thanks. Bye.